The thing is, nobody really wants to listen to the guy screaming about market corrections when things are going well. But when the Nasdaq is down close to 20% and you wake up every single day to the markets down 2, 3, 4%, a lot of people unfortunately hit the panic button and start making stupid decisions. And so this is exactly what's happening right now. So today I want to give you 7 basic rules, not only how to survive a market correction, but actually thrive when one happens. Whether it's beginning of 2022 or later on when you watch this, you want to be prepared for these corrections. And so, full disclosure, some of the lines in today's video I actually stole from one of my favorite investors, Josh Brown, who runs a wealth management company in New York. He recently put these together in an article that kind of really voiced exactly what I'm thinking and what I'm doing. I didn't invent any of this stuff. He didn't invent any of this stuff. We just know that this works. Let's talk about it. The most important rule for surviving deep market-wide corrections is, first of all, to realize that it's not about you. This is typically indiscriminate selling. Because when the VIX, the volatility index, is going up to 30 and above, every single trader out there, every single hedge fund guy, every single money manager, they're selling what they can because they have to make space in their portfolios. They have to meet margin calls, meet redemptions, reorganize. So whatever's sitting in your portfolio, whatever your individual stock choice is, it's really got nothing to do with you. But this indiscriminate selling is also quite good because it's typically close to the end of it. It's typically close to when the market capitulates and turns around when it bottoms out. So remember, try to remember this next time. It's not about you. It's not about your individual choices. The market isn't watching you, and your specific emotions and actions are not a signal for anything. Rule number 2, and this is a great psychological trick. You put in some good till canceled buy limit orders on your favorite stocks, but at levels that are far below the recent highs, at levels that only a few weeks or a few months ago you would dream about getting. You make sure there's enough money in the account to cover these fills, and sometimes you get filled on your stocks at ridiculously low levels, and you manage to double them very quickly as the market recovers. And this happens more often than you would think. Even over the last 10 years during the bull market, think back to January, February 2018, a huge market sell-off. Think back to June 2016 during Brexit. Think back to 2015 during the Yuan-Chinese crisis. In a typical investing years, these opportunities come around about twice a year when you have that 10-15% market correction and you're able to load up at ridiculously low levels on companies you always wanted to have, but they were always too expensive to buy. The third point I want to make is that you need to realize that you're still a forced buyer of stocks through whatever retirement plans you have, whatever 401k contribution plans you have. You're still buying stocks at all times, right? You're systematically contributing to these plans. So I want to flip this whole correction logic on its head. When a correction happens in the market, you should not be calling your financial planner or your broker asking what the heck is going on. You should be calling them asking how much more money you can wire to them to buy more stocks. Because ultimately, do you want to pay, the real question here is, do you want to pay all-time high prices for these purchases? Or do you want to buy them at lower prices? I know you know that lower prices is what you want to be buying at. So market corrections ultimately, unless you're 70 or 80 and you're really not looking 20 or 30 years ahead of market purchases when it comes to investing, market corrections are actually good for you because you are ultimately a forced buyer of stocks through your contributions to your retirement accounts. The next thing you often hear people talk about when a market correction happens is that they'll just tell you, well, I'll just go full cash and then I'll just invest again when the correction is over. Well, maybe this works once or twice, but you can't really time the market reliably. It's just basically assuming that at any point in time, you know what 100 million other investors are going to do. This all-in, all-out mentality just doesn't work over time. And so the real difference here is the difference between intelligence and temperament, right? You may be the most intelligent investor out there, but really it's all about the temperament that you have of how you behave during market corrections, because you can't allow yourself to be super bullish at all-time highs. And on the other hand, you also can't allow yourself to fall into complete despair and fear when the market correction happens, because that way you will definitely lose permanently. The next point I want to make is it's so simple, and everybody will tell you, of course I know this stuff, but it's so often forgotten, and it's simply that the basics about diversification still work. And if you look a year ago, everybody wanted to be in Tesla, in Moderna, in EV stocks, in biotech. Now it's early 2022, these things really are not working, but you want to be in bank stocks, in energy, in utilities, and these things are kind of saving your portfolios right now. My point is, you want to use a correction a sell-off to rebalance opportunistically, be diversified and rebalance in the sectors that maybe 6 months ago were not in favor, but you know that they will work over time. And finally, the last point I want to make about this, and this is in fact how Josh opens up in his article about surviving these market crashes and market corrections. And this is the shut the Nobody wants to hear you walk around and complain and bitch about how much money you lost in your portfolio. Everybody's portfolio is down. Everybody's losing money in a market correction. So walking around and complaining is really not how you want to behave. You don't want to be going around and saying, oh, Jim Cramer told me to buy this stock. He's using this really cool word that I like, comportment. You want to comport yourself, which I believe is also very British. But just carry on. Everybody's losing money. And so while you're at it, once you reallocated your portfolio, once you put in your good till cancel limit orders at ridiculously low levels, once you've rebalanced, once you put together your strategy and executed it, it's time to go and focus on something else. Don't watch every single tick. Don't watch your trading platform every morning like a hawk. Go do something else. Go work on your honey to-do list. Go skydive. Go have an affair with your neighbor. Go do something else. Money managers are in this 24/7, but you don't have to be. So use these market corrections and market crises and sell-offs to your advantage. Rebalance opportunistically, re-strategize, reallocate, but don't waste your life on market crises. All right, so much for advice on how to survive market crashes. Thanks for hanging out today. Subscribe to the channel if you haven't yet. Give a like to the video if this is useful for you, and I will see you in a future video.